Joining us right now is Priya Misra. She is fixed income portfolio manager at JPMorgan Asset Management. And Priya, let's weigh through everything you just heard from these two, what you saw with the numbers. What does Jay Powell say tomorrow? How does he tee all of this up?
So I think the Fed, as well as Chair Powell, they have a really tough job ahead because the dual mandate is intention, right? There's inflation's not at their target, and there's inflationary pressures with tariff. Even service inflation's higher than where it should be. So you've got that inflation conflict or above target, and you've got the job market, which, you know, I know that the claims did pick up, but overall we think we're in a low hire, low fire economy. There's big questions. How much of this is cyclical versus structural? We don't know actually how weak the labor market is. So if I were Jay Powell, I don't commit to anything because there's another payroll report, there's another CPI report before that September meeting, and sort of leave it to the data. Let the market reprice based on the data rather than the Fed's reaction.
That's an excellent point that we have another data point. We are used to getting this Jackson Hole readout from the Fed to say, what are we really teeing up for the next 6 months to a year? It may be a time to step back, but if he does that, if he doesn't jawbone and talk the market's expectations down, you're going to see a much bigger reaction in the markets if they get surprised by no rate cut come September.
I don't think he'll take it off the table either. I mean, the one thing where he can maintain the easing bias is to talk about the fact that interest rates are restrictive. And I think the majority of the Fed believes that somewhere in the 3% would be neutral. We're running at 4.5%. So this idea that the easing bias remains when they feel better about inflation and, you know, inflation expectations, wages, all of that allows them to cut, they'll cut. I think if they keep it in the horizon, you may not get as much of a reaction. And I think he's going to say, well, if the data requires it, we'll cut. I think that can keep the hope alive. There may be some disappointment tomorrow, though.
I know, Priya, that you're a fixed income manager, so you're looking at the bonds market's reaction to all of these things. But I know you have to be thinking broadly about what's happening with the economy, too. The big question that keeps coming back is the consumer slowing down? Is there potential for an economic slowdown or even a recession on the line? What do you think? That has to be the basis for any other decision you're making.
Great question. And the data has been volatile, right? You had that one labor report which moved the market as much. So we take a step back. Let's look at the trend. The trend over the last 6 months is things are slowing down. The consumer is slowing. We look at, you know, whether you look at real consumer spending or you look at PDFP, that's our favorite measure. It's the private domestic sales. So you take out inventory, take out government, take out net exports. It's
that
slowing.
Is a good number.
Right. Yeah. But it is slowing. It's not falling off a cliff. So what we're calling this, is this a soft, if I was an equity person, I call it a soft landing. Bond people call it sub-trend growth. What is that? You know, 1.5% GDP that can allow the Fed to cut a little bit, maybe, you know, get to neutral, and not a whole lot more. We don't need accommodation. That's how we see the economy slow down. I mean, but I will say we came into this year with very strong consumer balance sheets and corporate balance sheets. And it's been impressive that earnings have generally held up. The one caution would be prices have not gone up that much. And so as tariffs have to be paid, so far the companies have taken it. Do they start to pass it on? That will be the real test. Can consumers continue to spend as prices go up? And we think there may be some slowing there, which will allow the Fed to cut.